Hi, this is Trevor with Red House Lending, and I'm going to explain a big misunderstanding about interest rates that I hear from clients quite often. And that misunderstanding is how the Federal Reserve and when they cut rates, how it influences but is not directly related to mortgage rates. So, all right, let's start at the beginning. When the Federal Reserve cuts interest rates, they are cutting a rate called the Fed funds rate. And this rate is used between banks. So the Fed fund rate is the rate that a bank is allowed to charge another bank for a loan. So what happens is we'll just use Bank A, Bank B. All right, so at the end of the night, let's say Bank A has more loans than it has deposits. And so it has to balance its books. All right, so what they can do is they can borrow money from Bank B, who, let's say, at the end of the night has more deposits than loans. So the Fed funds rate is the amount of interest that Bank B can charge Bank A for borrowing the money. And that is how the Federal Reserve affects the economy, right? So what does the Fed funds rate actually, how does that translate into the consumer, right? So you'll know that maybe you don't know, there's another interest rate out there called prime rate. And that's the most popular understood rate. It's published in the Wall Street Journal. And prime rate, the idea behind that is the rate that a large bank would charge its best clients. Normally, normally the prime rate is the Fed funds rate plus 3% normally. So for instance, let's say, just for easy numbers, that the Fed funds rate is at 4%. Ideally, prime will be at 7%. And so how does that affect consumers? Well, a lot of credit cards are tied to prime rate. It's some credit cards do prime plus 10%. Some do prime plus 20%, and you're paying 27% interest. All right, so that is how the Federal Reserve affects the economy with interest rates. So there's other things that are tied to prime. A lot of times, HELOCs are tied to prime plus something. So if you have a really good relationship with your bank and you have a really good credit score, sometimes you can be a subprime lender, right? That means borrower. Borrower. That means that the lender will give you an interest rate lower than prime. Now, how does that go into mortgage rates? So what you have to understand is that mortgage rates are its own market, right? So there is an instrument, and when I say instrument, that's what the financial world calls them. Stocks are an instrument, bonds are an instrument. So there is a type of bond called a mortgage-backed security. And that is how mortgage rates are priced, right? So in the mortgage-backed securities market, what you really have to understand is that a mortgage is nothing more than a bond, right? It's the exact same idea. So, not to get too technical, but when a bond price goes up, the interest rate goes down. That is merely the equation inside and how they calculate interest in a bond. That's how the mathematics work. I won't go any further than that because it gets a little complicated, and I'm not here to complicate you. So a mortgage-backed security, let's say today, is trading at $100. And tomorrow, the the mortgage-backed securities market thinks that interest rates are going to they're going to change. Let's say they think that the Federal Reserve is going to change the rate, the Fed funds rate, next week to go lower. So if that's at 100 today, the mortgage-backed securities at 100 today, they think in next week that the Fed is going to lower interest rates. They will actually purchase the mortgage-backed security and say if it's at 100, they're going to, by no means, I'm just doing easy numbers here, they're going to purchase that bond at $101. And in that transaction, that makes the interest of the mortgage-backed security go lower. And so therefore, that is how pricing of mortgage rates work. So, moral of the story is when the Federal Reserve changed the Fed's funds rate, when they quote unquote lower interest rates, the market, the mortgage-backed security market is already anticipating what they're going to do. So what happens, and what's happened lately, is let's say the Fed cuts next week. So fast forward, or next week, say the Fed cuts on Wednesday. A lot of times, mortgage rates will go higher the day the Federal Reserve cuts because they're more interested in the comments that the Federal Reserve Chairman says about future interest rate cuts. So the rate cut that they're going to do on Wednesday has already been priced in to the mortgage-backed security market because they anticipate, they look forward on what's happening. So if you want to take a quick glimpse into the future, and just on interest rates, not on anything else, but if you look at the federal yield curve, right? The yield curve is nothing more than the mapping of a 6-month Treasury note, a 1-year Treasury note, a 5-year Treasury bond, a 10-year Treasury bond, and a 30-year Treasury bond. Well, when you look at that, when you price out, and this is very simplified, just giving you an idea, but that day, if you look at a 30-year Treasury bond, that interest rate that's coming off that bond, that's where traders think in 30 years, interest rates are going to be as of that day, right? And it changes every single day, but it gives you a glimpse on where the market thinks interest rates are going to be. So there is a correlation between the 10-year Treasury bond and also mortgage-backed securities. Those two track each other pretty closely. They're not exact. And the spread between those two, between the mortgage-backed security price and the 10-year Treasury bond, the spread, the difference between the prices or the interest rates in those two are tracked closely because that's a good indication of where stuff's going for mortgage rates. So again, the biggest thing I get is that when the Fed cuts rates, people think that the mortgage rates are going to go down that day. That's not what happens. If you're waiting for the Fed to cut, you're already behind on the interest rates because the mortgage-backed security market looks into the future. They anticipate what the Fed is going to do. They do not wait. And also, that interest rate that the Fed changes, does not directly affect mortgage rates. There is a correlation, and I'm sorry if I'm saying this wrong. I'm sure somebody that knows stats is gonna watch this and just rake me over the coals, but that's okay, right? There's a correlation, there's a relationship, but they are not directly affected. There you go. It's a fairly complicated idea, and I tried to explain it as easy as I could. So I hope this helps, and of course, always reach out to me if you have any questions. Be glad to talk about this all day, every day. Thanks. Bye.